Welcome back. And in our top business story, Dubai and Abu Dhabi are some of the world's most competitive cities globally, according to a new report. The Economist Intelligence Unit research report ranked cities in terms of their ability to attract capital, business, talent and tourists. Out of a total of 120 major cities, it revealed that Dubai came in at the number 40 spot, with Abu Dhabi just behind at 41. It showed that European cities were the most competitive, with London at the top spot. In terms of economic strength, Doha and Abu Dhabi made the top 30 for the region. Dubai ranked 10th under the measure of financial maturity, and Riyadh came in 8th globally as the least risky in terms of environmental and natural hazards. 9 out of 10 of Dubai's finance executives are confident in Dubai's growth prospects this year, with 72% looking to expand their staff. A recent survey by recruitment specialist Robert Half UAE shows that rising workloads and mergers and acquisitions were the main reasons behind potential staff expansions. The report interviewed over 2,500 CFOs globally, 75 of which were in Dubai. Finance seniors in Dubai shared the number 1 position with Brazil in terms of confidence in their country's growth. 91% of CFOs globally are more confident than they were last year, with China at 87%, Hong Kong with 82% and Chile at 79%. The National Bank of Abu Dhabi approved the distribution of 30% cash dividends and 35% bonus shares to shareholders. The announcement was made at the annual general meeting yesterday at the Emirates Palace in Abu Dhabi. Addressing NBAD's shareholders, Nasser Ahmed Khalifa Al-Sawaidi, the chairman of the NBAD board, stated that global economic activity slowed down in 2011 and near-term prospects deteriorated against the background of fiscal problems in developed economies. Economic activity in the UAE picked up modestly, expanding by about 4% year on year in 2011, up from 1.4% in 2010. He added that NBAD's vision is to be recognised as the world's best Arab bank, with a target of achieving 16 billion dirhams in net profits by 2021. And now let's take a look at the stock indices across the GCC. Some analysts are already saying Greece might need a third bailout in the future and that Spain has to deregulate its absolutely inflexible job market. Well, to talk about this further, we earlier spoke with Philippe Dauba-Pantanacce, the senior economist at Standard Chartered Bank.
Yes, indeed, Spain managed to negotiate with the EU leaders a softer target for its budget deficit in 2012. And now they will only have to achieve 5.3%, which is a much softer target than what the EU leaders initially had in mind, which was at 4.4%. And the argument from the Spanish government was that the budgetary deficit that they found from the previous administration was much worse than they expected. I think that this will give some breathing room to the Spain government, as the recession is definitely threatening. Now, for Greece, it's a different case. Nobody's talking about a third bailout. But what's for sure is that it's difficult to imagine that the path laid out for Greece down the road will unfold without any events, and that the numbers that have been thought of for the Greek plan will completely square very nicely in the upcoming years. But what's for sure is that here again, we bought some breathing room and some peaceful time, I would say, which is definitely something that the market needed in the current environment.